You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome back to the show, everyone. Today, my guest, of course, is my guest for every Wednesday show is Zulfe Ali with Valerity Wealth. Zulfe, welcome back.
Great to be back, Buck.
You know, I'm sure you listened to this show this week. It's not necessarily, I would say, something that you spent a lot of time on, but we talked a little bit about this whole taxocracy, you know, this idea that taxes basically dominate the essentially what businesses do, what everybody does, all their behavior. And there's a lot of truth to that. I'm not sure if you have anything to add on that, but.
Well, listen, I think, some very scary topics, particularly when, your guest was talking about, potential taxes on assets. I just hope those types of things never become reality. But, we just can't count on the government to not mess up tax policies. So
well, we already know that's policy in some parts of the country. I know I had an investor in Israel, actually, who said that at least on the value of his house, like the appreciation, he gets taxed in real time.
Wow.
Yeah.
That would be painful because then like you guys are saying, you got to come up with the liquidity, right? So all of a sudden you have to start thinking when you're buying an asset like that is, okay, not only do I have to pay this upfront purchase price, but I better have liquidity as an ongoing matter because every time, values appreciate, I'm going to be paying. So when the asset depreciates, do they get a benefit then from the government? Probably not.
We didn't get that. We didn't get that far, but you would think they'd get some sort of, refund or something like that. But it is kind of crazy to me though, that, this is, that people are, that they're really throwing this stuff around there. But again, I just got to think that, this kind of policy just wouldn't fly in America. I just feel like
I don't think that that's specifically what I'd be worried about, but I think my perspective is that it's a safe assumption. Taxes on individuals and business are probably going to rise from where we are. We're enjoying relatively historically low tax rates, right? Since the 2017 cuts that Trump administration passed, we've got corporate tax rate at 21%, where they used to be, 35% at the high end. You've got individuals, topping out at 37% federal marginal tax rate, whereas that was 40% before that. And then if you go back to, pre-Reagan, you're talking about 50% plus, right? So we've been a lot higher in the past. I think there's just so much pressure on government to raise tax revenue, given the amount of money that they need to raise to finance the national debt, to finance the huge fiscal policy programs, to fund national security. We talked about Medicare and Social Security. Those are all huge programs that need funding, and the money's got to come from somewhere. So I just think there's just a constant pressure here for whatever administration takes office, whatever party is in control. I just believe that over time we're going to get higher and higher tax rates to deal with.
Yeah, it's who knows, right? I don't know where the political will for that is, though. It's not on either side. At least if you go back to what you would call the neoconservative era, it was Bush's and Reagan and stuff like that. There was this strong emphasis on fiscal austerity is the wrong word, but at least trying to make cuts and trying to simplify government and bureaucracies and costs and things like that. But there really isn't that anymore either, right? It's like even people who are putting out signs out there who think they're being small government and telling the government to keep their hands off of their Medicare, you know what I mean?
Yeah.
And all that, but it's tricky, but it's hard to imagine that at least those pressures are going to go away anytime soon. Speaking of Social Security, isn't that going to get depleted pretty soon? Isn't that going to run out?
There was actually an official report put out by the Social Security trustees, and they basically now have, a forecast that all of the Social Security funds in the trust will be depleted by 2035. So not all that long from now. So some sort of solution has to come into place to address that. At some point, it's going to be in someone's lap to deal with, and they're not going to want Social Security to blow up in their lap.
Well, it just doesn't seem quite fair either. I mean, people are putting money into Social Security right now, and if you are not of a certain age, at this pace, there's you're not going to see any of it back. It's just insane, right?
It is insane, and it's actually a pretty significant, particularly if you're talking about professionals.
Mm-hmm.
Let's say a married couple that have had very large W-2 incomes for a long period of time. That Social Security benefit can be worth $1 million. I mean, it's not peanuts. And I think a lot of people just discount it these days and say, okay, well, I may never get that, therefore I have to plan around it. But at a certain degree, it, like you said, it's money we've put in, so we should get it back at some point. So we need solutions there for sure.
Yeah. Okay, so you talked about the sort of the inevitability of which way things are going and upward pressures on taxes, which I don't think anybody's denying that. I mean, what's going to happen in the next 4 years, who knows? But in the long term, with the rate we're going at, I think it's hard to imagine that taxes will not have good chance of going up. When you just know that that's going to happen, what are some of the things that you tell your clients of Valerity Wealth?
I think the way we approach it is, obviously we want to make sure that all of our investment strategy is done in sync with tax advice, with asset planning. I think you need to incorporate all of those different expertise when you're, thinking about how to manage your finances and how to plan for the future. So, the tax code changes on a yearly basis. Sometimes there's some pretty significant changes. So you have to have a really good tax specialist on your team. So think of it that way, as the right kind of skills you want to have assembled on your team. So that's the way we've been approaching it. Is ultimately you can't avoid taxes, and I really like the way that you had mentioned, the way you look at taxes, which is a series of incentives put forth by the government, for us to follow. That puts you in the right frame of mind. That is, you can't avoid them, but there is a path to follow to minimize the tax burden, and that's written out in the tax code. And you just got to figure out the tax code, which is not easy.
Yeah, I think part of the important element too that you're talking about, with regard to having a strong team, and I know you guys are working with like Doug Lodmell and some of those guys over there, but just in terms of even like long term, estate planning, those kinds of things. The estate tax is one that I can, even though I guess statistically it's never gone down per se, but it is really hard for me to imagine that the estate tax is not going to come under a major reduction going forward. So when I was interviewing this guy about that, one thing that I was kind of surprised, I was interviewing this guy about that, and he was talking about, kind of delaying, setting up those kinds of trusts and actually donating to those kinds of trusts. And I actually completely disagreed with him. My feeling on it was that, like, if you know that there's a certain law right now that you can take advantage of, for example, right now that you've got this giving ability up to, approximately $12 million as a single person, or, more than that later. But and maybe that number right now looks like, hey, that's a huge number. I don't have to worry about that. Well, what if that number shrinks down to, 2 million or 3 million? And, the thing is that I think the idea of making plans ahead of time so that you're grandfathered into various laws is a very good idea. And that's what a good tax attorney, a good estate planning person, a good asset protection person will tell you. And that's, useful to have a team for. So, all right, well, let's kind of skip on to talking about what's going on. I mean, part of why we're doing this is to kind of keep an idea on, what the current market is on a week-to-week basis as we crawl through this mess of an economy that we've been dealing with the last couple of years?
Well, you say mess, but the stock market does not
He doesn't believe me.
follow that pattern.
Yeah.
You probably saw the Dow Jones is at all-time highs, hitting 40,000 for the first time ever in history on Friday of last week. It's up beyond that today. S&P index is up 12% from the beginning of the year. Remember, that was up 26% last year for the full year. NASDAQ is up 14%. That was up 43% last year. So, at the end of the day, the equity markets are doing phenomenal. Bond yields have cooled off, meaning bond prices have been going up, and rates have been coming down since kind of the early May time period. There's been a little bit more, I think, investor belief that the inflation numbers are coming in slowly but in the right direction. There was CPI print last week that was more friendly, so that was certainly in the right direction.
Yeah, that's the funny thing about it though, is like, I mean, again, yeah, you're right. I mean, I'm looking at this from the perspective of real estate, right? I mean, real estate, we're still kind of waiting for rebounds, but all these things that are going on with the stock market and with bonds, these are all like, hyper acute responses to news, right? I mean, the CPI barely went down. It barely went down, right? Like it was a very small amount. The market just responded to that like gangbusters. And, obviously bonds too, same way, right? Like just I guess if you're talking about 10-year treasury or whatever, they're just assuming that, it's headed in the right direction. And I do think it's going to head in the right direction because of conversations we had in the past, but it just does seem like a massive reaction to very, very small bit of news.
Well, it is a massive reaction, just in numbers, but I think it's the expectation change that gets built into the market. Very much, I think, accentuates the movements, the volatility, and then there's just so much cash swishing around, right? So there is a lot of cash on the sidelines, and if there's a little bit of feeling that the market's getting better, then you start seeing that movement of cash from the money markets, for example. Again, we mentioned that there's $6 trillion just sitting there. When that starts moving, it's going to create a lot of big impact. There is lots of liquidity out there. When you look at, for example, assets like Bitcoin rebounding to all-time highs again, you're seeing the advent of meme trading coming back with some crazy stuff going on the last few days there. And then on the flip side, gold is also at an all-time high, right? So gold, people usually view that as a safe haven when things are highly volatile, high inflationary environment, yet gold is going through the roof. And I think there's a lot of interesting dynamics there as well. So
I don't know what overall, gold, what happened with, is that gold? I don't know if you looked at the gold numbers. Did that respond to the interest rates at all?
Well, it's been going higher. I mean, you would have thought that given that there was a slightly softer CPI and therefore the pressures on inflation were off a little bit relative to expectations, you would have thought gold would come down. It's not come down. It's continued to go right through and up.
I should point out similarly, like, the Bitcoin thesis, right, is ultimately like it's digital gold. And right now, I mean, as I sit here, it's Bitcoin's at 69,000. That's pretty darn close. What was the high? The high was 73.
73, I think.
Yeah. So we're getting real close. But again, it sort of doesn't make sense because in theory, if it's digital gold, if the idea is the interest rates are coming down, then these numbers should be coming down, right? They shouldn't be going up.
They should, except, Bitcoin's been a weird one because I think that there has been that theory that it is digital gold in that, it kind of, it should trade the opposite, but it hasn't, right? It's kind of traded in line with the market. There's a high beta.
Like tech. It trades with tech, basically.
Yeah, it trades with tech. When tech's flying, Bitcoin's flying. So, I think as that asset class, Bitcoin, as it matures and takes on more of that commodity type of, investor base, I think that's what it will, mature into, but that's not where it's at today. It's definitely, trades in line with the tech markets.
If Dow just sitting at 40,000, first time ever in history, S&P is, up over 12%, all this stock market activity. What do you do? I mean, if you're, I'm not a stocks guy, but you just keep putting money into this thing.
It goes back to diversification, right? So everybody's licking their wounds on real estate for the last, 2 years. Well, if you would have had your portfolio somewhat diversified in some of these asset classes, you'd be like, okay, I'm taking a hit one side, but on the other side, I'm making good capital, right? So I think that's the theme that you just have to continue with, is that, you really don't want to be sitting on the sidelines. There's not much to gain. I know that 5% money market type return is attractive on the face of it. But my gut is that, what happens is, as soon as the Fed is expected to take down the Fed rate, as soon as there's, another maybe more favorable print on inflation, all of a sudden those money market rates will disappear, right? They just go away. You haven't locked in anything,
and maybe
right?
that's the impetus for some of these markets to come back. You know what I mean?
Yeah,
when
I
you
think
can't
so.
get the yield, in money markets, when you can't get 5% there, and it's now you're back to a couple percent, then you go chasing yield, and that's when that $6 trillion starts to drift out.
Yeah, I think it will. I think it will, and it'll drift out pretty quick. But then, on the other side, all these asset classes are just going to keep going straight up, right? Because that money's going to come into these asset classes. So, so again, if the question is, what do you do today? I think you make sure you're deployed. I think you make sure you've got good diversification, and it meets kind of your objectives or what you're trying to achieve in your financial goals. You write it out. Yeah, sure. There's a chance that, things don't perfectly map out the way that, the markets are expecting right now. But, there's a decent chance that, that they will as well. But again, if you're well diversified, you should be able to manage through, the different scenarios that are happening.
Yeah. Well, good stuff. I think, we'll wrap it up there. Just a little update for the week. Again, this is brought to you by Zulfe's Valerity Wealth. Just give us a little blurb on Valerity Wealth, just so people remember.
Sure thing. Valerity Wealth, we're a registered investment advisor. We are basically working with high net worth individuals. And again, taking a very integrated approach on investment strategy, integrated with tax strategy, integrated with asset protection. Think of us as a family office type service, where we're looking at all your financial needs from a very holistic perspective.
Again, that's sort of a unmet need in this demographic of high paid professionals, people who are sort of, maybe you're making $500,000 a year, whatever. You're not going to go out and get your own family office, but you're getting to the point where your finances and all the things that revolve around it, estate planning, asset protection, taxes and stuff, get very complicated. And it's helpful to have a group like Valerity around. Thanks so much for being on, and I'll catch you next week.
Sounds great, Buck. Thank you.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.